Hey everyone, welcome back to Option Alpha. I'm Kirk here again, and we're going to go over inverse ETFs on this particular video. So, as we all know, ETFs are very popular and becoming more popular, and as the development and issuance of regular ETFs, so have the issuance and development of inverse ETFs. Have started to really ramp up, and really over the last 2 or 3 years here, have a lot of inverse ETFs have started to come out. So not only that, but there's also double long, triple short, double short, etc., etc. So what I wanted to go through here is a simple example that shows you guys some of the risks that are involved in some of these double and ultra long and ultra shorts ETFs. So follow along with me. It's going to be really easy, and then we'll take a look at an actual example to really prove and drive home the point here. So inverse ETFs, right? Let's use a simple savings example just to kind of get our bearings here. Let's say we're going to save $100 at 10% per year. So again, after the first year, this is simple math, we'd have $110 in our account, or a $10 profit, right? We made 10% on our initial $100. Let's say we kept that money in the bank, and so after 2 years, we have $121. So not another $10, but an actual $11 profit. And that's because we made an extra 10% on our $10 profit, which is an extra dollar, which is why we have $11. After year 7, you can see we'd have about $195, which actually turns out to be about a 13.55% return. So again, not exactly the 10% return that we had initially thought. That would be simple interest, but we're dealing with compound interest. So let's take and now put that $100 into three different funds. So we'll call Fund A just a simple index fund, and this could be anything from the SPY to the DIA to the Qs, etc. Fund B, let's go into a double long ETF. Okay, so a double long or an ultra long ETF. And then in Fund C, what we're going to do is we're going to go, double spelled wrong. We're going to go into a double inverse ETF. So again, a double short or an ultra short. So going over these, let's assume that we get a 10% return today. So again, ETF funds are calculated on a daily basis, not a monthly or yearly basis. So let's say we get a 10% return today. And again, simple math here. After day 1, Fund A, which is just the index, is $110. So it started at 100 and it's now at 110. After day 1, Fund B, which is our double long, is going to be at 120 again. So we're making double what the daily return is. So the index returned 10% today. We're going to make 20%, twice that value. So again, this is really where the advantages to these come into play. After day 1, Fund C, which is our double short, is going to lose 20%. So again, losing double what the index made. So we're going to be down to $80 in that value for that portfolio. Now let's move forward, and let's say that the next day, on day 2, the index actually returns negative 10%. So on average, giving about a 0% gain. So it gives back all the gains from yesterday. But now the numbers start to look a little bit different. Fund A is at 99%. 10% of the 110 value, which we were last at, is $11. So we're actually going to give back $11 if we lose 10% from there. So now the fund is going to be just below breaking even. Fund B, which is our double long fund, is going to give back 20% of our $120 value. Remember, it made 20% the first day. And so we're going to give back about $24 and be at $96. So again, below par. And Fund C was going to make 20% instead of losing 20% of 80, which is 16. And again, being back at 96. So you can see if we repeat this process for about 6 months straight, 10% up days followed by 10% down each day, Fund A, which is our index, would be at roughly 95.10 on average. Fund B and C would both be at approximately $2.54. So you can see that both of these leverage ETFs have lost nearly 97.5% of your investment. Now talk about a tracking error on the part of these ultra fund brokerage houses, right? These are supposed to track them 10% up, 10% down, double up, double down, but you can see that if you actually do the math and work the numbers out, that they actually start to lose money over the long run. Okay, so let's actually take a look at a real example here on my screen. So again, we're back here on my screen, and all I've done here is go to YCharts, which is a great website, ycharts.com, and typed in the QQQ, which is the Pro Shares. It follows the NASDAQ. It's the NASDAQ ETF. And so what I've done here is I've actually put in the QID, which is the double short, or the ultra short, I'm sorry, and then the QLD, which is the ultra long of the Qs. So again, I'm just doing the same portfolio that we had assumed before. Same thing, 3 different portfolios, an index, an ultra short, ultra long, etc. And so I've put the returns on here for the last 5 years. And so you can see that the the orange is actually the index, is the Qs, or the QQQ. The blue here is the QID, which is the ultra short. And then the red here is the QLD, which is the ultra long of the Qs. So after all this time, after 5 years, you can see we obviously had a really good return spike in the QID, which is the ultra short during the market crash of 2008-2009. Absolutely, definitely really shows the advantages of having these in your portfolio if you are going to use them for short-term hedging or for short-term directional plays that you're going to speculate on. And you can see that as the markets were falling, these went up almost nearly 100% at one point. But over the long run, you can see here that after 5 years, that the index is still far outperforming both of these leveraged ETFs. And what's funny here is that actually it's outperforming the QLD, which is the ultra long ETF. Now, isn't that funny? The index is supposed to be up 28% over the last 5 years, but the QLD should be up more than that, right? Double what the index is up, but it's not. And again, this is where that pricing differential comes in. It's adjusted on a daily basis. So this daily change in the markets have a negative impact over the long run. And so the longer this goes, the more the negative impact it's going to have. And you can see that the QID has already decayed tremendously. It's down about 77% over the last 5 years. So this really drives home the point, and this is a live example. This is data I'm taking from tonight when I actually just went in here and just put in some data for November 2011, the last 5 years, and ran the numbers for returns. So it's really interesting. As always, I want to point out these different kinds of risks. I think a lot of people get confused when they start talking about inverse ETFs. They really get excited about buying some of these inverse ETFs and then profiting whenever the market drops. But that's not really the case, as we've seen here. So use them wisely. Know what the risks are. As always, there's good and bad to both. There's advantages and disadvantages to both. I'm not saying one's better than the other, but this really drives home the point of the pricing differential between these leveraged ETFs.